Hello everyone, hope you are doing well. Welcome back to the Road to Retiring channel. Today we're going to be having a look at a stock recommended to us by Lars2678 on a recent video. As you can see, we've already done a WNS analysis yesterday and that was really interesting, and so I advise you checking that one out. However, you can see he also has on his watch list CSL and UFPI, and today we're going to be jumping into CSL. So if there are any stocks that you personally would like me to have a look at and give my own personal fair valuation on them, then please do drop them in the comments down below and I'd love to take a look. But let's take a look at CSL today. So, the first things that I like to see are consistent growth rates in equity, EPS, operational cash flow, revenue, and then the total average of all of those put together. This are the average growth rates for Google. If we put in CSL, the ticker in here, you can see that the average total compound annual growth rate for all of these put together is above that benchmark I like to look for at 10.57%. And most of this is, even though there's 3 of them which are below this benchmark, you can see operational cash flow and revenue are quite close. They're both in 9% to 9.5%, so they're both pretty much there at that benchmark. The one worry is the equity growth. It's not really growing at a particularly fast rate, so we're going to have a look at that in a second. Maybe we'll increase our margin of safety slightly because of this, but it's definitely something to keep in mind. So that's one thing we like to look at when considering the growth of a company. Now, if we have a look at equity growth, let's see if we can understand why it hasn't grown so much. Now, obviously, for those of you who don't know, equity is your total assets minus your total liabilities. And you can see the total liabilities are, if we change to annual, they're growing their assets really quickly, but they're growing their liabilities at about the same rate. So for every asset they are adding, they're also adding an equivalent amount of liabilities. Not quite exactly, but it's a similar amount, which means that their total equity is really not moving too much. And okay, it's jumped up quite a bit from 2021 to 2022, but really only 200 million change from 2016 to 2021, moving from 2.5 billion to 2.6 billion, so not super fast growth there. So it's not something to worry about because their assets are still comfortably over their liabilities. It's not something I'm particularly worried about, but it's just something to keep in mind. If the liabilities start catching up to the assets and this equity starts to fall, that's when we really need to become worried. But for now, I think that's okay. I'm alright with the growth not being crazy for the equity, as they are still increasing their assets at a nice rate. Now, I like to look at a company's decisions. How are they investing? And so for this, we look at their return on invested capital. I like to see around 10% or higher for this. And if we have a look at their return on invested capital, currently it's at that level. It's at 14.38%. So right now they're making good decisions, but I want to see consistent good decisions above that 10% mark. And if we look annually, you can see that there's actually been a really big jump up sort of from 2021 to 2022. And previously, it hasn't been so consistently above this benchmark. You can see 7.76%, 7% here. They were above it in 2019, but again, 2018, 2017, 2016, they weren't. So that's 5 out of the 7 years, of the 5 of the last 7 years, they haven't been above that 10% benchmark I like to see, where a company's consistently making smart investment decisions. So for this, I'm going to put on a tiny bit of an increase to our margin of safety. I'm going to go for a 15% margin of safety instead of the 10% mark we usually look at. And if you have a look at the metrics here, you also know that I want to see the financial health of the company. I want them to be able to pay off any sort of long-term debt they have within 3 years of their free cash flow. I want their free cash flow to be able to pay off that long-term debt. And it can, but barely. So I think it's comfortable leaving that margin of safety at 15%, because you can see the free cash flow comes in after 3 years at 2.45 billion, and they have 2.2 billion in long-term debt. So they can pay off that long-term debt within 3 years of their free cash flow. But if that free cash flow were to drop a little bit, or their long-term debt to increase, then that could quite easily not be paid off. It's not doing it by a long margin. So I think, we're happy to leave on that 15% margin of safety. And as I say, this is trading, I'd say, on average around 8-9%, a little bit below that return on invested capital we like to see. We put CSL into our automated sheet, which we've done here. you can see that straight away on the automated sheet, it's coming up at 6.5% undervalued. Now, I wouldn't recommend just using the automated sheet, but this is good to give you a benchmark, an idea of ones that are worth looking into further. And yeah, coming up with an average fair value 6.5% higher than the current market price means that it is at a good value right now. But I need to check the manual sheet. We need to make sure we're putting in these smart decisions. You see the automated one only has a 10% margin of safety. This is why you want to make sure you're using the manual sheet for these decisions. So let's have a look. How many shares do they have outstanding? We're going to fill in all the yellow boxes, and this is going to give us our fair values. So common shares outstanding for CSL. Well, if we have a look here, you can see that if we remove the return on invested capital from the graph, they are buying back shares at a really nice rate, from 64.2 million in 2016 all the way down to 51 million pretty much in 2022. And even from there, it's down to basically another million, because you can see currently they're at 49.92. So they are buying it back at a really nice rate. If we look here, you can see share count minus 3.64% a year. Now that is absolutely fantastic. So I'm not going to go quite that ambitious. I'm going to go for minus 2% personally, because minus 3.64% is really aggressive. And again, this is another reason why I don't just want to take the values on the automated sheet. You want to put in your own to account for some sort of safety and a bit more of a margin of safety on that. Now, I also have to put in that common shares outstanding, which we have now, which is 49.92. So we're going to add that to the here as well. Now you're going to see this realistic growth rate is updating as we're changing all of these things. And the last thing we need to put in to calculate this realistic growth rate for the company is the earnings per share in 2023. So let's jump over to earnings here. Let's look at annual, and you can see 2023 is $17.25 expected for earnings. Now that has dropped slightly from 2022, and the growth really isn't now super consistent with the company. I know we said it has that high growth that we like to look for when we looked at our metrics here, but when you look at it in a bit more detail, 2015 to 2018, fantastic growth from $5 per share to 10. However, from 2018 to 2021, it actually fell by $2 a share, and then had a crazy jump in 2022, and then falling again in 2023. So the growth isn't super consistent, and I think this is another reason why it's good to have that extra margin of safety for a company like this, because it's not super predictable what their growth is going to be like. And despite a 15%, as you can see, 5-year prediction the analysts have put in for growth, for my own value, once we put in the 17.25, you can see the realistic growth rate is only 8.68%. So I'd like to be a little bit more on the safe side, especially as their growth rates are so sporadic. And I'm going to go for 10% for my own personal earnings growth rate to make sure that if we are buying this, we're getting it at a really nice price. So I'm going to go 10%. We just have to add in our price of earnings multiple, and this will give us our price of earnings fair value calculation. So based on the price of earnings, you can see in the past sort of 5-6 years, it's traded quite sporadically from 11.2 all the way up to 27.87, and then it's been in the 16s, 17s, 19s. So you know, those high teens to 20s is pretty much where it's traded. It's had that high growth in recent times, which has bumped up that PE, but as this growth starts to fall again to levels that aren't quite as high, as I say, you can see 20% average growth, and obviously 2021 and 2022 was absolutely ridiculous, and I think this bumped up the price of earnings a lot. But personally, I see 16.25, that feels like a decent range. If we have a look at the current sector median, this is 17.56 for CSL, and their current value is 16, so it's a little bit under their 5-year average, which is nice to see. But the fact they're trading under the sector median, I do feel like the sector median will come down a tiny bit. I think the market's quite high at the moment because it's had a really strong year. The market's been really good this year, so I think the sector median will fall off a bit. With that, CSL could come back a little bit as well. So I think around 14.5 is where I feel comfortable. And that's not super far off. That's a fair value of $252.85. So only a 9% drop. And we've seen those prices recently. So right now it's $277.62. However, you can see that just as recently as May, it was all the way down in the 200s. So there's been a massive growth recently, and I think if you were to have got in before sort of mid-June time, that would have been a fantastic time to get in based on this price to earnings fair value. But let's have a look at the others as well. Check that this averages out to a price that is maybe worth buying into now, or if it's one where we should wait to see if it drops a bit more. So let's have a look. Price over sales fair value. Now the revenue growth rate doesn't look as ambitious as the earnings. As you can see, the earnings are going quite aggressively, whereas the revenue is only moving to 6.3 billion in 2025, which is actually still 200 million lower than it was in 2022. So this to me, again, it's not fantastic. It probably means our price of sales fair value isn't going to be as high, but we're going to put in our values here. So 5,730 million in revenue expected. This is going to go up to around 6,300 in 2025, probably around that 5% mark. Yeah, that takes us to 6 million or 6.3 billion, sorry. Now the price of the sales multiple, it's not easy to guess where this should sit. It's consistently climbing, as you can see here. It's kind of on an upwards trend, but over the last few years, sort of since 2020, you can see it's sort of gone back and forth a little bit to as high as 2.7 in 2021, and all the way back down to 1.8, and now it's on its way back up again. I feel somewhere in between those regions. Currently where it is feels pretty reasonable, around that 2.3 mark. It's where it's been trading for around 2 years. It's been sort of bouncing between those levels. So 2.3 feels all right for a price of sales multiple. It feels like somewhere the company will sort of trade at as a general. And if we look at the price of sales fair value calculation, this is not as strong as the price of our earnings, unfortunately. This fair value is $211.50, meaning we need a 23% drop. Now, the price of sales is quite different to the price to earnings, and as the price of operating cash flow, sort of driven by similar factors to the earnings, typically it's made up of those earnings. It just includes other factors that you've got to be aware of that are really important to be aware of, and that's why I like to include it in my calculation. But you can see the funds for operations, the net income plays a big part in that operational cash flow that we're seeing, and now this is obviously driven by the earnings. But right now you can see the funds for operations is sitting at around 1.05 billion on the trailing 12 months, and the change in working capital has actually bumped that value basically up by 100 million to 1.15 billion. Now if you have a look, change in working capital is all over the place. It was loads in quarter 4 2022 at 200 million, but some quarters it can be minus 200 million. So I like to sort of base the operational cash flow off of the funds for operations. So I'm going to go for 1,050 in our operational cash flow for 2023. The growth rate, again, we're going to keep this kind of similarly in line with the earnings. I think around that 11% mark, growing slightly faster than earnings because it is made up of other factors such as the depreciation and the non-cash items. It should have a few hundred more million making it up. So I'm going to have that growth rate slightly increased. And the multiple, now this is where things aren't super easy. You can see 14.3 is the multiple that has been put into our estimation from our graph. 14.3 feels a little bit high because that's not really accounting for much safety in case it doesn't hit those levels. You can see the sector median is 14.5, and it is again currently trading under that sector median level. And as I said, I think the sector in general, the market is quite high at the moment. I would expect this sector median to potentially fall a little bit, and with that, now you can see over the last 5 years the average has sat at 17.53, so it has traded as sort of a much higher premium than it is now. But I think as the growth rate slows down, it will fall a little bit to more in line with the sector median, and as I expect this to fall to a little bit, I'm going to go for 12 as my price operational cash flow multiple. And based on this, that's only 4% out from the current market price. And when we take this all together, this shows that right now, if you were to buy, you'd be looking at a 10.25% return on your investment each year. So it's not by any means a bad price to be buying at all. And 12% as the fair value is a lot closer than most of the stocks I'm looking at the moment. 12% is not a massive drop. I could easily see that happen. As I said, we're looking at 243. It has traded at that sort of level very recently. You can see just in late June, so just over a month ago, it was at those levels, and it's been climbing quite consistently. So if I had looked at this a bit earlier, I very may well have looked to pick it up if it was in that sort of May, June time when it was really down here. But right now, I'm going to keep an eye on it, and if it hits those levels around 243, that's where I become interested. I hope you enjoyed this little dive into Carlisle. Please let me know if you enjoyed the video, and drop a comment down below for any other stocks you're interested in and you would like me to have a look at. For now, it's been Road to Retiring. I'll catch you in the next one, guys. Please subscribe, and peace.